Hey guys, okay, welcome to lesson 11.7 for consumer math. Very interesting topic today about buying stock, because I've told you guys about stocks, about how stocks are part of the company, but I'm really glad that we're getting to the section to where you're really going to see it, because it's easy to listen to that stuff and be like, okay, I really don't understand what she means by that, so I don't know what she means. I'm not gathering much knowledge until I see it and study it. So here we are, seeing it and studying stocks. Okay, so look at it. Make sure you're reading along with me, because you need to see these words, these technical terms. Okay, look what it says. You may want to become part owner of a corporation by purchasing shares of stocks. So I've talked about this before, but let's go through it again. Let's take like a company like Facebook. Facebook was privately owned for years, okay? Meaning that nobody from just no rich person or no person out in the public could just come in and buy part of the company, okay? They kept it privately owned. However, as a company grows, it's just known, it's the culture that a company will go public. And what that means is that you open up your company to be able to be shared with other people in the community, other people in the public, if they pay enough to be part of the company. The reason why it's kind of like a cultural thing that people do that is because it's just expected of you that if you have a large company, or you have a successful company, or you have a company that is solid, you have enough confidence in that company to be transparent with people. Meaning that you can show them what you're spending your money on, you can show them what you're gaining money from, and they can be a part of that. So if they buy stocks, if they purchase shares of stocks, they're going to have part ownership in the company. Now, us normal people that don't have a lot of money, if we buy shares in a company, we're not going to buy not even 1% of that company, but we're still going to benefit from owning part of the company, okay? So let's see how. It says when you purchase stock, you receive a certificate showing the number of shares you own. So they're called shares, okay? How much you share of the company, or they share with you, right? As a stockholder, you are taking more risks than a bondholder. Why? Remember what we talked about before. According to the government, the company has to pay interest on their bonds before they pay dividends on their stocks. So if the company fails, or the company loses a lot of money, which happened this past year for the pandemic, they don't owe the stockholders anything, okay? You don't even come into the stock with an agreement, meaning like your agreement is that you're going to get money if they're doing well. If they don't pay a dividend that year, if their stock price doesn't rise, then you lost money, okay? Unless you stay with the company for a while until it goes back up, okay? And we'll talk about that in a second. So there's a lot of risk to stocks. So some people say that Christians should not be involved too much with stocks, where it becomes too risky of selling and trading stocks every day. They say that some people have the standard that it's gambling, that it's not wise to do that with your money, because you are at a risk to lose a lot, just like if you were to go into the casino, okay, is what people say. Other people say that there's a science behind it, that you have to just do it wisely, okay? And so you have to make that decision, if you're in the position to invest money that way, okay? So it says on the next one, as a stockholder, you are taking more risk. A bondholder has reasonable confidence that he will receive the face value of the bond when it matures. However, a stockholder is guaranteed nothing. As a stockholder, you will profit if the company profits, or you will take a loss if the company fails to profit. Well, it makes sense because you become part of the owner of the company. A bondholder isn't like that. A bondholder just has an agreement, okay? But if you're part of the company, then you have to be with the company when it fails and when it does well. As a stockholder, although the stock market is a risky investment, millions of Americans own stock because stocks have the potential to have a greater return than any other investment. Remember I told you before, it's one thing that you learn. I was studying finance, I learned this every year. More risk, more possible return. More risk, more possible return, okay? So yeah, stocks are risky, but they also have potential for great return. Okay, financial advisors suggest you should be reasonably debt-free. and have 3 to 6 months pay in a savings or checking account before investing in stock. Okay, so you shouldn't be investing in stocks if you have debts and you don't have enough money in your savings. The liquid money is necessary for emergencies, okay? That's your priority. Liquid money. Liquid money means this. You can get a hold of the cash immediately. That means in a savings account or a checking account. Not in stocks where you have to sell it and see how much money you get. Not in bonds where you have to wait for the face value. And not in CDs where you have to wait 3 months, 6 months, or a year to get your money out or you'll get penalized. Okay, that's not liquid money. Stock is liquid, but you risk selling at a loss if you must sell quickly to get needed cash. So again, not wise. The two types of stock are common stock and preferred stock. The common stockholders vote for the company's board of directors and administrative officers. The number of shares a stockholder owns determines the number of votes he is allowed. Okay, so you're part of the company, you're making decisions. Preferred stockholders do not possess these voting rights, but they receive dividends, percentages of the company's profit. That's what I was talking about. Instead of where bonds give out interest, stocks give out dividends. Okay, money as the company profits. So maybe every quarter they give out dividends, every year they give out dividends. It depends. As the company profits, they give out money to their stockholders to reward them for being part of the company. And the preferred stockholders get it before the common stockholders do. Since the preferred stockholders receive their dividends first, the common stockholders may receive smaller dividends. If the company profits greatly, the common stockholder may receive the greater dividend. Next paragraph. The par value of stock is the amount printed on the stock certificate. N is the price for which the stock is initially sold. So when you get your certificate for the stock, you get a par value. That's the price that you bought it at. Then it's going to either rise from there or fall from there according to how well the company does. If a company issues stock with no printed value, it is called no par stock. The market price is the current selling price quoted in dollars per share. The market price changes often and depends upon the confidence investors have in the company. That is something that you really need to study out to really understand how stock prices rise and how they fall. Okay, but basically the bottom line is it depends on the confidence investors have in the company. So for instance, during the pandemic, we lost a lot of confidence that businesses were going to succeed, so the prices went down. Okay, guys, the rest of this gets pretty technical, but remember, it's just an introduction. And then whatever you don't understand, if you study it out a little bit more in the future, depending on what your carrera is and everything like that, you'll still have the base. It says a quotation of 13 3/8 means the price of one share is $13.37.5 or $13.375. Beginning with the year 2000, fractions will not be used. Daily newspapers publish the prices of some stock. An enlarged example of the stock report is given on page 340. Remember the Wall Street Journal? They have this all the time. Okay, so look at page 340. So what does all of this mean? You have the stock here is right here, the name of the company, okay? Aetna, Air Product, Albertsons, Boeing. You see Walmart, Pepsi Company, Tupperware. Okay, all famous companies. Okay, I'm not going to even explain why I changed clothes. This is like 4 days later I'm making this video. But nonetheless, here we go. Let's get into this. Okay, so we're looking at the different companies. And now down here is going to give us the explanation of everything that this table means. Okay, so let's look at it. You need to colocar it. You need to look for it on the table so that you know what we're talking about here and how to read this table because it is important, okay? It says 52 weeks. The 52 weeks high and low refer to the highest and lowest market prices of the year to date. So that means every week is the 52 weeks. So like, okay, let's say for example right now, we're going to be in, let's say we're in April 1st, okay? In April 1st, you're going to be looking at this table and it's going to show you the high and the low price since 52 weeks back, which is where? Which is back to April 1st of the year before. Okay, so it's always showing a whole year. It's always showing those 52 weeks, and it's rolling, which means, okay, you're in the next week and it's showing the next 52 weeks. So it's moving with you to always be showing 52 weeks from behind, okay? The highest and lowest market prices of the year to date. That's what that means, year to date. Aetna had a high market price of $115 and 875 cents. Okay, so 115.875. You can see that. Look at Aetna, the very top one. Look at the high, 115 and 7/8. So they just convert it into decimals. And a low market of $57 and 0.625 cents. Prices are given in dollars and fractions of a dollar. Beginning in 2000, only decimals will be used. Okay, so now if you were to look at the selected stocks, the high and the lows, you're only going to see decimals there in like the Wall Street Journal and the newspapers. Look at the stock. The stock is the name of the company. I already told you that. That may be abbreviated sometimes. Okay, Aetna is the abbreviation for Aetna Life Insurance Company. DIV, D-I-V. DIV refers to the annual dividend paid per share of the stock by the corporation. We already talked about the dividend. The amount that they're giving you. Aetna Life paid an annual dividend of 80 cents. So that means that for the amount of shares that you had, let's say you had 25 shares, they multiply 25 times 0.8, and they get how much money they're going to give you of the company's profits that they're paying out to the loyal stockholders, okay? So it's just like interest on a bond or something like that. And the fact that they're paying you out a little bit of your investment into the company. The differences between bonds and stocks is that the dividend can change all the time. And they don't owe you anything. Okay, so if they decide not to pay out a dividend that year, they have all the right to not pay out the dividend. And they don't have a set dividend. So like when you go into buy your stock, you can't say like, well, I want this % of the dividend. No. You get whatever they gain, okay? The bond is locked in the amount of interest that they give you. A savings account is locked in the amount of interest that they give you. A certificate of deposit is locked in with the amount of interest that they give you, and they're obligated to give it to you. Stocks aren't that way. They're not obligated to pay you the dividend, and they're not obligated to promise you how much of a dividend you're going to get, which is why, again, there's risk in buying stock, okay? Yield percentage, YLD, is yield. The dividend is the dividend as a % of the closing price. Okay, so you look at Aetna, it was 70% of it was 0.7% of the closing price. So the yield percent is found by dividing the annual dividend per share by the closing price per share. Okay, so the yield percentage for Aetna was found by dividing 80 cents, which is your dividend, by 114. Okay, which if you look over on the side right there is your closing price, 114. Okay, so you just do annual dividend per share divided by your closing price per share. Okay, let's keep looking because there's more. I'm going to hold my book open like this. The PE ratio, you might remember that from last year when we were studying chapter 12 together, which we're going to study again so that you understand it better. The PE ratio is the abbreviation for price to earnings. Earning is ganancia, right? So that's a ratio of the closing market price to the corporation's annual earnings per share, okay? So look at the formula, closing market price divided by corporation's annual earnings. A ratio is a comparison using division, okay? Just remember that. The PE ratio is found to the nearest whole number. The stock information does not list the corporation's annual earnings per share, but it can be found by using the formula above, since the PE ratio and the market price are given. So look, the PE ratio is given, 27, right? The closing market price is given, 114. What is not given is the annual earnings per share, okay? So, but if you want to find it, all you have to do is use the formula. 27 equals 114 over X, and then you solve for X. So that means that it's $4.22, if you see right there on the example. That's the corporation's annual earnings per share, okay? And that's what you can use to compare other companies. If their earning per share is greater, the company is doing more successful and it takes care of its stockholders, okay? If it's smaller, maybe it's a sign that they're struggling and you need to watch it, okay? A lot of people that invest either pay someone to watch the numbers or they watch the numbers for themselves. There's a lot of ratios. I talked about this last year a little bit with you guys. For those of you that watched it, if you guys watched the videos in the fourth parcial, that there's a lot of ratios to watch to see the health of the company. Okay, and that's not what we're going to go into today. Today's just a basic introduction to it, but it's very interesting. All these ratios that you can take, all the information, all the financial information of a company is found on their website if they're a public company, which means you have access to everything, and you can calculate the ratios, the formulas that show you the health of a company and how well they're actually doing, because it's not just about looking at their profit. And you can tell if that company is long-term a healthy company to invest in. Okay. Sales 100s. Okay, well, let's look at the column just so you know what we're talking about. It refers to the number of shares given in hundreds that were traded that day. Aetna had 3,218 shares traded. That's 321,800. All you have to do is multiply by 100 or put 2 zeros at the end, because it's 3,218. Okay? The high, this is not the 52-week high. This is just the high, is the highest market price paid that day of the share, and the highest so the highest one that day was 114.125, and the low is the lowest market price paid that day, 111.625. It does depend on what time of day you buy your shares, okay, because it's going up and down all of the time. That's what the New York Stock Exchange is for people to be on the floor watching those prices, when you should sell, when you should buy, how you're going to gain your money if you're investing like that, which a lot of people do. Invest minute by minute, day by day, etc., etc. Because it's like a game to them, okay? It's like a high-speed business to be on the New York Stock Exchange, which we talked about in economics class 2 years ago now, okay? Look at the close. The close refers to the last market price for a share of stock. The closing market price for a share of Aetna stock was $114. Net change, CHG means change, is an abbreviation for net change and refers to the difference between this day's closing price and the previous day's closing price. Okay, so you can see that Aetna went up by 1/16. Okay, the closing price either increased, that's why it has a plus, or it decreased, that's why it has a minus, or it remained the same, which would have 2 dashes, which none of these do. Okay, it didn't remain the same. It's rare that it would. Since Aetna had a change of a positive 1/16, the closing price for a share of stock is 0.0625, higher today than the closing price for a share of stock yesterday. Stock prices are said to rise or fall. Of course, a stockholder hopes the price will rise. Net change equals closing price per day, and closing price today minus the closing price yesterday, okay, to see if it's going up or going down. If you were looking at these numbers when the coronavirus started a year ago, you would have seen continual down negative numbers for a month there, okay, before it started going up again, because the whole world freaked out about that and didn't know what was going to happen to the companies, okay? So let's look at model problem number 1. Find the cost of 150 shares of McDonald's at the lowest price of the day, okay? So you look at McDonald's, find McDonald's. Okay, you look at the low for the day. So what is that, 52.5, right? That's 52.5. That's $52.50 was the low price of the day. It says right here, find the cost of 150 shares at the lowest price of the day. So you had 52.50 times what? 150, because there's 150 shares. So that means that total cost of the stock for the lowest price of the day, if somebody was buying 150 shares, was $7,875. Model problem number 2 says, find the missing information in the stock market report. If the corporation's annual earnings were $4.12 and yesterday's closing price was $53. Okay, well, let's just go through it. You look at the yield percentage. Remember, the yield percentage is over here. Annual dividend per share divided by the closing price per share. I'm just going to speak it to you. If you need me to put it on the board for you, just let me know. But I think that you guys are at the point now in your mathematical skills that I could speak these formulas to you and you know how to use them. Okay? So, annual dividend per share is $2.64. You look at that on the div, right? $2.64. Then the next part of it was the closing price per share. That's your closing price here was 53.5, 53.5. So your yield is $2.64 divided by 53.50 because we're following the formula on 340, and you're going to get 4.9% yield, okay? Which is a good yield, by the way. A good giving back. More than Aetna, which was 0.7, okay? Then we find the PE ratio. You look over here. The PE ratio was closing market price divided by the corporation's annual earnings per share. The closing market price was $53.50. Again, we use that $53.50. And they give us the annual earnings per share, which was $4.12. Remember, they gave you that in the problem. You divide those two and you get the PE ratio of 13. Okay? And then you need to find your net change. That's just going to be the closing price of today minus the closing price of yesterday. In the problem, they give us the closing price of yesterday, which was 53, and today was 53.50 again. So 53.50 minus 53 is 50-cent change, which is positive 1/2, right? Okay, positive 1/2. I don't want to get it too complicated right now, but PE ratios that you're looking at, just let you know to comment on the fact that the PE ratio of McDonald's at this point was it McDonald's that we were doing? Oh, McDonald's is up on the other one. We don't know who this was. But 13 as the PE ratio, just to comment on that really quickly so you know. When you're dealing with ratios and you're studying them, you need to know, like, what is the average ratio or what is a good ratio. You look at the number 13 and you're like, I don't even know what that means. Okay? What that means is that it traded 13 times higher than what it's earning, basically, which means that the higher the ratio, the more trust the stockholders have in that company to grow and to make more money, okay? They say the average for a good company, which is an S&P 500 company, are good, strong companies. There's 500 strong companies inside the S&P 500 list. An average ratio there is 13 to 15, okay? So if you go above 15, which they say of all the stocks, usually the average is 16. Those are healthy ratios, okay? So 13 to 16 is basically a healthy ratio. If you go above that, for a short period of time, it would be a good thing because that means that the company is expecting to grow. But if you're too far over 16 for a long period of time, people might be overvaluing the stock, which means they might be having too much confidence in that stock that they're paying way too much for the stock, okay? 25 for a consistent amount of time that you're paying 25 over the share, 25 times the share, might mean that you're really just getting ripped off. You're getting estafado, basically that they're making you pay too much money for that stock. Okay, it's overinflated. Now look, on the exercises 1 through 8, I want to give you the answers to those because I want you to understand this information. Okay, so I'm going to give you the true and false and kind of the explanation on those, but the rest of them are up to you. So let me just give you the answer for number 9 is 4,350. The answer to number 15 is 25 cents. Okay, so a positive 0.25. Just to let you know, just so you can check yourself on that. Look at number 1. Stocks are less of a risk than bonds. I did say this, but I'm going to say it again. It's false. Stocks are always considered riskier, okay? More of a riesgo for 2 different reasons. 1, it's volatile, which means it's always changing. And 2, the company is not required to give out a dividend like it's required to give out your interest. Number 2, stocks are liquid. Liquid means that it can be turned into cash quickly, and it's true it can, but you might suffer a loss, so it's true. Number 3, stock purchase at a quotation of 49 3/8 is guaranteed to be worth $49.375 when the stockholder sells the stock. That's false. Okay, it's always changing. The par value of a stock in its current selling price. That is false. Remember, the par value is the original price of the stock. Number 5, common stockholders cannot vote for the company's board of directors. Remember, there was a difference between common stockholders and preferred stockholders. It is false that they cannot vote. Okay, just let's go really quick back to that to clarify common stockholders. Common and preferred. Common stockholders vote for the company's board of directors. The number of shares a stockholder owns determines the number of votes he is allowed. Preferred stockholders do not possess the voting rights. Okay, so it's preferred that do not vote, common do. Preferred stockholders receive dividends before common stockholders receive them. That's true. That's the benefit of being a preferred stockholder. And the kind of compensation for not being able to vote, right? Number 7, a net change of positive 3/4 means that the closing price for a share of stock today is 75 cents more than the closing price yesterday. That is true. And number 8, sales are given in thousands in the stock report. That is false. Sales are given in hundreds. It says right there in the column. Okay, the rest is to you guys. Thanks for listening. I know it was a long one, but it's very important information. Bye.